Hi, my name is Roger Schluter. This video is really on what is an actual note. I know people sign these and they don't think a thing of it. Anyway, what is a promissory note? Is basically what this video is about. And basically it's a legal document by a party promising a second party to pay a debt. It is a written agreement signed by a party with a promise to pay an amount of money on a date or on demand. It's like an IOU. And what's kind of funny is there aren't as many notes done where it's payable on demand. But I know years ago it was a pretty normal practice, especially with the smaller banks, to say, this is let's say this is a 48-month note, that is going to be paid off in the 48 months or on demand. And a lot of times they put that or on demand in there, and that's why SBA, when they do a loan, when they guarantee a loan for a bank, they won't let them put that demand feature in. Because the demand feature is there is that if everything goes wrong or something, that they can actually demand that money at that time. And it doesn't work out well for the borrower. It may work out well for the bank, but for the borrower, it can be a nightmare. So anyway, this note that we're talking about is not related to a currency note or a bank note. Those are different animals altogether. And then promissory notes are a type of a contract. And there's basically four kinds of promissory notes. There's a personal promissory note, between you and somebody else. There's the commercial one, number two, that is usually with banks or credit unions. There's the real estate promissory note, where if you're in default, one party has the right to take possession of the real estate. And then there is the investments, and this is usually related to a rate of return. Features of the promissory note. Now this isn't the most exciting video, but it does kind of tell you what you're signing and tell you really what's in it. Features of the promissory note. Number one, it's a written agreement. It is to pay a defined amount of money, per month, per year, at the end of the contract, whatever. It is a signed document. It is an unconditional promise to pay. And it is a payment in the nation's legal currency. This could be brought up sometimes when you're talking, where different nations have debts with other nations or other groups, and they pay off these bonds or these debts, and a lot of times it's stipulated in how you're going to pay it. And I mean, in this day and time, it's usually in dollars, so they want to pay in dollars. I've seen Russia want to pay in rubles, and different nations want to pay in different currencies. And normally these are detailed. It's detailed what you're going to pay in. And normally, if you're in the United States, you're going to pay in dollars. If you were in another country, you could pay in dollars because we are the reserve currency of the world reserve currency. But you could it could be payable in a different type of money for that particular country that you're in. And of course, there's detailed information in this: the date, the term, names, the people involved, principal amount, the rate of interest. There's a whole lot of detailed information in it. And then promissory notes can be very simple, or they can be very complicated. Normally banks will make them fairly simple. The problem with some notes is you have some verbiage in there that you may not be familiar with, that you may have to look up, or you may have to ask an attorney about. Loan agreements are usually more complicated than a promissory note, but they're kind of the same thing, or their agreement on a loan. So anyway, but when they talk loan agreements, they're usually talking about a more complicated document than a promissory note. That's really it on promissory notes. Now I've kind of added a bonus here. I've also done not only promissory notes, but I'm basically saying what is a security agreement. And if you've done a promissory note, a lot of times you'll have another document that the bank will have, and it's called a security agreement. And a lot of times you don't know what it is, but the bank is, you got to sign this, you got to sign this, and sign this, and you're signing everything. And you may ask what it is, but a lot of times the borrower does not know what the heck he's signing. He just knows he's getting the money, he's got to pay a certain interest rate over a certain period of time, and he better pay it on time. But anyway, the security agreement really provides a lender with a security interest in a specific asset that is pledged as collateral on the note. So anyway, the security agreement attaches that collateral to the promissory note. It usually has terms and conditions. If a borrower defaults on the note, on the promissory note, the lender can usually take possession of the collateral and then sell it off to the debt that is owed, sell it off to pay off the debt that is owed. A security agreement, this agreement can include, a repayment schedule, it can include insurance requirements, it can include covenants. Covenants are kind of different things. Covenants are usually a condition to be maintained, kind of like a cash amount to be maintained by the company, or certain ratios to be maintained. A lot of times they put them in like current ratio, or which is kind of related to money that's still available, or to equity ratios. They want the business to maintain a certain equity and not take all the money out, of the business. A security agreement that takes equipment as collateral may have a UCC-1 filed in a state system, and it's basically a lien on that property, lien on that equipment, whatever that is. Filing a UCC makes the filing public information. So people, since it's a state system that this UCC is filed into, you can basically look it up. You can look up the company and see if they have, any filings, against that company, and I think you can also find out what those filings are. So anyway, the UCC serves as notice to other lenders that the collateral is already pledged to a lender, which is really good information because businesses have been known to sometimes pledge collateral to more than one lender, which is illegal and shouldn't be done. So anyway, many times, even though the promissory note and security agreement are separate documents, they are both produced at the same borrowing. So basically, the lender will have the note, he'll have the security agreement, and he may have a couple other documents. But those are the two main documents on the loan. And that is, the security agreement, that's what it is and what it does. It basically attaches collateral to that promissory note. And then the promissory note, when you read your promissory note, you're going to see it has most of those things. If it has things you don't understand or words you don't understand, I would ask the borrower, but I'd also look them up. And like anything else, I tell people this all the time, when you're talking documents that banks give you, have your attorney look at them before you sign them. And I know so many businesses that just don't want to do that because they really don't want to incur that charge, that they don't want to incur that legal bill. I tell you, most things like this, it's going to take the attorney less than an hour to look at. Attorneys charge $250 an hour or so, maybe more. But it'd be the best $250 to $350 you ever spent, to make sure, because there could be things in here that you're not aware of that are legal, but maybe they're just not pro you, maybe they're pro the bank. And a lot of times your attorney can say, hey, we can get this removed, or we can add in this or this to help you. So anyway, that's it. That's about about a note, the notes you use to borrow money, and about the security agreement. So if you like this kind of content, I hope you subscribe, and I hope you hit the notification bell that you can get other newer videos when they come out. And if this helped you out at all, I hope you hit the like button. Anyway, thank you very much. My name is Roger Schleter, and I will see you in the next video.